Hello everyone and welcome to this video. In this video, we are going to understand how the three financial statements are linked to each other. This is one of the few questions which are asked everywhere. So be prepared, and if you want to get into the finance industry, you should know this thing by heart. Without wasting time, directly jumping onto the income statement. Before that, I would like to mention like I have colored the things which are directly connected to each other. So you can see like the bottom line in the income statement, which is net income, is directly connected as the top line in the cash flow statement, and they both are in the same color. So to find out the gross profit, we just need to subtract our revenue from the COGS, and that gives us the gross profit. To find out the operating income, or you can say the earning before interest and taxes, we just need to subtract our SG&A from D&A, which is selling general administrative expense, and depreciation amortization. And here you go. And the reason why we are subtracting depreciation amortization income statement, and you can see we'll be adding back in the D&A in the cash flow statement, is because of the matching principle. So you can see the expenses that are recognized in this, like they should be recognized in the same period as of the revenue. And because of that, we are subtracting the D&A in the income statement. So to find out the pre-tax income, or you can say the earning before taxes, we just need to subtract the EBIT from the interest expense. And to find out the net income, we'll be just subtracting these two numbers. So over here, I would just like to mention about interest expense. This is something which tells us about the beauty of finance. As any company who takes on debt, they have to pay some interest to the bank from whom they have taken. And but as they take more debt and debt, their interest expense really increases. And as the interest expense increases, they need to pay less in the taxes. So you can see the beauty of finance over here. And that is one of the reasons why a lot of companies take a lot of debt. So coming back to the topic, as we know, the net income, which is the bottom line in the income statement, is directly connected as the top line in the cash flow statement. And in the cash flow statement, we'll be adding back the depreciation and amortization because it is a cash, it's not a cash outflow. Just because of the matching principle, we were just subtracting it from the income statement, but we'll not be subtracting it over here, and we'll be adding back. It is adding back, it's not a new addition. So remember that thing. So to find out the cash flow from operations, we'll be just add our depreciation amortization to the net income, and we'll subtract it from the changes in the net working capital. But over here, it is an increase in net working capital. So that is the reason why we are subtracting it in the cash flow statement. And net working capital, we all know, is like a current assets minus current liabilities. So it tells us about a day-to-day operations. So if it is increasing, it means like more fund and finance is being used in our day-to-day working activities. And because of that, the cash flow from operations will decrease. Now coming back to the part of capex, you can see again the capex is over here increasing, and the reason when we subtract capex and when we add back capex is very straightforward. As we know, capex is capital expenditure. It means like all the machineries that are in the firm, and if a company is investing more in long-term assets like PP&E, it means there is a lot of cash outflow, and because of that, the overall cash in the company is decreasing. So if the capex increases, the cash flow from investing decreases. So that is the thing you can see over here. And now coming back to the part of the cash flow from financing, it's quite straightforward. The debt that any company takes. So we can see the net changes in the cash by just adding the cash flow from operations to cash flow from investing to cash flow from financing. And here we get the ending cash. And as the company has not used that cash anywhere else, it will be taking, like it will be carrying forward. And here we get the 1110 from the last year, and at the end of the year we have 110 and 176 as the ending cash. And again we know like the ending cash, which is the bottom line in the cash flow statement, is directly connected to the top line in the cash flow in the balance sheet. So we'll be just adding back like not adding back, we just putting the cash from the cash flow statement to the balance sheet. And now you can see there are so many things which are directly connected to each other, like the net income is being used in the income statement and the cash flow statement. The depreciation amortization is subtracted and added back. And these are some the things which are a little bit tricky to remember, but these are the only places about which you like interviewer will ask you questions, so just be prepared about this. Now we'll be adding back the 110, 104 and the PP, and here we got 140, 160. Now to find out the liability, we just need to add back our accounts payable, and we'll be adding that to the debt. And one thing to mention, like again, the debt that is over here is the same as of that was in the cash flow statement, but you can see it's 50 and 60 in the cash flow statement, but as the company has taken a new debt and they have the previous debt also, so because of that it will be 110. That is one, that's 50 plus 60. Now talking about the retained earnings, again it is directly connected to the income statement. So coming to the income statement part, we're just directly like taking that net income from the income statement and placing it in the balance sheet because it is directly connected. And one thing to remember, retained earnings is net income minus dividends, and in this case we are assuming that there is no dividends, so because of that it is 15 and 21 the same as it was previous, like it was in the income statement. And to find out the total equity, we'll be just adding back, and I think we can uh, see how everything is connected to each other. So in the end, just wanted to tell you like the, just a minute, this, I think there must be some error. Okay, this is something that we need to, again, we have not added back our AR to this, and now here we go. So now all the balance sheet is balanced, and this is how all the three things are connected to each other. And in summary, I can just say like the net income, which is the bottom line, is directly connected to the cash flow statement as the top line, and again that is the bottom line in the balance sheet in the form of retained earnings. Depreciation amortization, which is subtracting from income statement, is directly added back in the cash flow statement, and the debt issuance in the cash flow from financing section is directly added in the liability section also. Thank you.